We're not even... Hi, everybody. This is Josh Jelinski, the financial quarterback. We're live on YouTube with Stan Harley. He is Chief Market Strategist at Wealth Quarterback, LLC, as well as the newsletter writer, chief editor of the Harley Market Letter. There is an echo in the audio because there are two mics. So I don't know why there's an echo. So we'll start once this echo is resolved. You ready? Okay. Hi, everybody. This is Josh Jelinski, the financial quarterback, on Clubhouse, YouTube Live, and taking your questions on WOR. So if you have a question on stocks, on technical analysis, on Bitcoin or more, we are with Stan Harley. So Stan, for our listeners who are not familiar with your work, describe your background in the markets.
Josh, I've been involved with the financial markets for, close to 40 years as a trader myself, and professionally for about 30 years. Have published a newsletter, and of course joined the firm here a couple of years ago as Chief Market Strategist.
Fantastic, and it's great to have you aboard. So what's going on? First off, let's talk about what happened in the market today and this week. Where are we in this bull bear market?
Josh, I think we are in the midst of a decline. I think the lows we saw in January of this year and the benchmark indices probably marked a significant high, what I'm calling a 7-year cycle top, and we've got a couple of charts to discuss that. But I think once the market has made a 7-year cycle peak, it's going to head south, and that's what we're doing right now, and we're about the midpoint in that process. And I think we've got some further downside, certainly vulnerability to explore.
So let's break down what happened in the market this week. We touched the low of June and actually broke through it. What does that tell us?
Until this week, the S&P 500 and the NASDAQ both had resisted breaking their summer lows. The Dow Industrials, the Dow Transports, the New York Composite did break their summer lows, and then just this week we saw the S&P break its low. So I think what we're setting up is potential further vulnerability into the month of October. Then I think we might get a little bit of a rebound into November. But from that point, I think we're going to head further south into probably the end of December of this year. And I think that's going to mark a terrific buy-in opportunity.
So you're optimistic, but not short term. Yes. So first, are you short term? What's going to happen in the next week or two? Obviously, you don't have a crystal ball, but we broke through the 36. We talked about this, I don't know, a day ago. It looked a little bit optimistic that we did not. We broke that 36. What was it? 36 what marker on the S&P?
Yes. Well, I think what it does is telling us that there's a potential for some southbound action ahead. How far down we go is difficult to say, but I think between now and the end of the year, 25,000-ish on the Dow Industrials is very reasonable. We're at 29 and change right now. 25,000 is a major demarcation line in the minds of millions of investors, and I think that's probably a reasonable target between now and the end of the year.
Wait, what did you say? 2,600 or
25,000 on the Dow?
25,000 Dow. Where in the S&P potentially?
In the low to mid 3,000s.
Okay. So, why do you think the market is going the way it's going?
Well, from a technical analysis perspective, we're looking right now at a monthly chart of the S&P 500.
And we're going to get that chart up on YouTube right now. So you'll be able to see it. Let's blow it up a little bit. If you look at our YouTube right now, we are showing the S&P monthly log chart. So, yeah, explain, why do you use a log chart?
Well, the market has advanced quite a bit. To use the arithmetic chart would be a little difficult to see because it would essentially be pointed straight up in parabolic fashion. So by using a log chart, we can kind of scrunch it down, make it a little bit more easily discernible, particularly in looking at cycles. And what we've done here on this chart, Josh, is highlighted a cycle that averages about 84 months. It expands and contracts, but nominally it's 84 months, which is exactly 7 years. And as you can see, going back the last 60 years, every 84 plus or minus a few months, we've made significant market highs. The latest recurrence in this pattern occurred in January of this year. And so predictably, we're heading south.
Is this the big one, the Magilla Gorilla?
A little early to say.
Okay.
A little early. I don't want to plant a
Well,
stake in the ground.
3,000 isn't Magilla Gorilla. I mean, it's bad.
Yes.
What would 3,000 represent from the peak?
Well, we topped out in the mid fours, so that would be
About a third.
yeah, that'd be about a third.
So pretty significant.
Pretty significant. I would point out that the declines from March of 2000 into 2002 and October of 07 and March of 09, both of those saw the Dow and the S&P decline close to 60%.
Wow.
So could it happen again? Sure. Will it? TBD.
How do you know that's going to happen?
I can't tell you the magnitude of the decline. It's challenging enough trying to figure out the cyclical functions. Predicting what's going to happen on the x-axis for me is a lot easier than forecasting what's going to happen on the y-axis.
Okay. So anything else that this 84-month chart would tell us?
Well, perhaps we can take a look at the second chart, and this same cycle will be very instructive, I think.
Okay, now we're on the New York Stock Exchange.
Stan can get to it. What I want to do is go down to the next chart.
That one?
No, it was one right above it. Well, that's okay. Yeah, go to the next one, please. Yes, that's it.
New York Stock Exchange.
Yes, that's it. This is the New York Composite Index. What if we can make it a little bit smaller so we can capture the full chart? May have to change the view. There we go. This again is that same cycle, but whereas the prior chart depicted the market highs, this depicts the troughs in that same cycle. And you don't need to use a computer. You can just use the old eyeball, and you can see, wow, every 7 years we tend to make significant lows in the stock market, like clockwork. And the analysis, when we get down to crunch some numbers, suggests this December might be an ideal time frame to look for the next low point in this 7-year cycle. And I think it's going to come in right about that time frame.
What's the significance of these vertical bars? I mean, does that mean it could go to 10,000?
No. I just drew those lines in just to highlight the troughs, the low points in this 7-year cycle. That's all that's meant to do.
Now, you had said something to me this week that was interesting, that if you look back, we sort of are where we were prior to the COVID crash.
Yes, and I have a chart right after this one that goes into that one.
Okay, so we'll go into that one next, but first let's talk about the 242-month low cycles.
Here's another pattern that I think is very interesting that also suggests a low this December. If we go back the last 100 years and take a look at a chart of the Dow Industrials, one can see that significant lows that have occurred at roughly 20-year intervals. Turns out to be 242 months, and it's 242 plus or minus 0. So every 242 months for certainly the last 80 years, we've seen significant low points in the stock market. if the pattern continues, 242 months from October 2002 equals December 2022. Just 3 months from right now. That lines up with some of the other cyclical analysis functions that we've looked at. Putting all these things together tells me, as a technical analyst, to look towards the December timeframe for what could be a really important standout low in the markets.
Why do you use October 2002 and not the '09 low here, the March?
Oh, well, that was a low, but a different cycle.
Okay.
No, I'm just highlighting this particular
What's the
cycle.
significance of the 242-month cycle?
Well, it marks what has historically
pivotal.
very important low points. There was a low in April 1942. There was a low in June of 62 that really stood out on the charts. Another major, what I call a springboard bottom in August of 82. Yes, there was an intervening low between the 62 bottom and the 82 bottom. That occurred in December of 74. But the cyclical low occurred in August of 82. 242 months later, October 2002. And then, should the pattern continue, it would suggest we should be looking right around December 2022, i.e. about 3 months from right now, for the next low in this cycle. And I think the evidence is very compelling that we are going to see a low then.
Oh, fantastic. So, folks, when we return, we'll be back with more technical analysis in the markets. We'll do Bitcoin technical analysis, real estate analysis, stock analysis. Take your questions on all matters financial. And, folks, if you want a free copy of Stan's latest work, we will give it to you for free when you schedule and keep your own portfolio review. That's a 27-point ultimate financial game plan. Call us now, 888-988-JOSH, 888-988-5674, 888-988-JOSH. We'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback, with Stan the Man Harley, who we're going to talk to him about how he was the original Tom Cruise first. And then we'll go back to markets. So describe your time, like your background, MBA. I know you went to UT Austin. Talk about, like, how'd you get into the financial markets?
I graduated from the University of Texas with a degree in aerospace engineering. And from there, I joined the U.S. Navy and served as a naval aviator for a number of years, flying the F-4 Phantom, the F-14 Tomcat, the F-18 Hornet. After the Navy, went to work in aerospace at Northrop Grumman, was there for a number of years, and ended up getting into leaving the defense world, and in the early 90s, got involved with the financial business, and have been doing this for the last 30 years.
So how many years did you serve in the military?
I was in a little over 9 years.
Wow. And what... I know your nickname. I remember your nickname was Hog.
That was my call sign, yes.
Why did they call you Hog? Harley Davidson?
Well, actually, yes. When I checked into my squadron VF-102 down at NAS Oceana, I, of course, didn't have a call sign. And one of the pilots in the squadron used to have a Harley Davidson motorcycle. Harley motorcycle,
yeah.
I'm trying to say. And he thought, given my last name being Harley, I should have the name Hog. I hated it. Let everybody know I didn't like it. That was the worst thing you could possibly do when you join a fighter squadron, is tell people you don't like your call sign. Hog doesn't like his call sign, Hog.
So you were Hog.
Yeah, they wrote it in big letters all over the board, spelled it H-A-W-G. And I protested, but it stuck.
It was a little bit foretelling of the future. You know, bulls make money. Bears make money, pigs get slaughtered. Do you ever make that connection?
Yeah.
So it gave sort of destined you were predestined for the markets. So how did you fly? So you flew, what type of plane did you fly?
Started out in the F-4 Phantom. Then we transitioned to the F-14 Tomcat, which is where I have the majority of my flight time. And then I got some flight time in the F-18 Hornet as well, stationed out on the West Coast.
So what makes someone want to become like a fighter pilot or whatever you would be called, I guess?
Yeah, good question. I think.
Meaning, was it something like my 7-year-old's like, I want to become a baseball player? Were you
Sure.
like, I want to be? When I was a kid, I actually had a little stint where I did want to join the Navy and go to Annapolis. There was like I had this little kick. Did you have that as a kid? Where I want to.
Well,
serve
actually,
the
yes.
the US?
I grew up in that environment. My father was an Air Force officer, so we lived on military bases all my life. He was a fighter pilot, so I grew up in that environment,
Cool.
and he certainly was instrumental in molding me the way I am today. And in college, I thought perhaps I would, instead of the Air Force, go in the Navy and fly airplanes. Given that my degree was in aerospace engineering, I thought it would be good to have some experience flying them. And I did that for a number of years.
So you had experience landing. How hard was it to land a plane on an aircraft carrier? It's probably
For
harder.
Navy pilots undergo a lot of training. It takes just a huge amount of training to learn how to land on a ship and learn all of the what we call the boat procedures, everything connected with landing and flying around an aircraft carrier. It's complicated, but it's doable. It's learnable.
Wow.
Even I learned how to do it.
Yeah. Well, you're a pretty sharp guy. So, fantastic. So, folks, we will take your questions. Jim can check the YouTube for questions. I will check the Clubhouse chat for questions. Okay, so now we're going to go to the Dow charts. Let's go to the Dow chart.
Here's the Dow chart as of today. And just in the last few days, the market has been hesitating. The volatility essentially has dried up. And one might wonder, well, why? What's going on? Well, the simple explanation is the market, as measured by the Dow Industrials, has pulled back to the same level where it was in February of 2019, the so-called COVID high. And that was also the high in September of 2020. So with those two highs standing out on the chart, former resistance, now serving as support, the Dow has been holding up here for the last couple of weeks. However, I think it's probably going to break this area of support starting next week. And I would not be surprised at all a week from now to see the Dow Industrials back in the area of the October 2020 lows. So that would put us down somewhere in the mid 26,000 range. I think that's possible. That's very possible.
So that's the bearish case. So we break through 29,140. I guess if we don't break through that, that's bullish. Like, what would make you a bull?
Well, the time cycles are not there yet for a bull market to renew at this point in time. But I would need to see the market across the board, the 5 major benchmark indices, the Dow Industrials, the Dow Transports, the S&P 500, the NASDAQ Composite, and the New York Composite, all of them stabilize, stop going down. We need to see the advanced decline line stop going down, and we would need to see a significant reversal back to the upside. That within the context of when the time cycles say a reversal is likely. All of those things together would then change my view from suggesting there's downside vulnerability to more in terms of bullish potential.
Sure. Wasn't there something with your time cycles talking about October 6th for a while?
Yes.
Is that still the case?
Still is. I'm looking for a low in the vicinity of October 6th. Yes,
Okay.
next week. Yes. So I think we're looking at...
So next week could be really bad. Or it could be good or not really?
I think next week is likely to have some weakness. The shorter term work suggests a low next week, a rally into the election, and back down for a final bottom at the end of December. It is conceivable the majority of stocks make their lows next week, right around October the 6th. And we get some kind of sloppy rally into early November, back down again and retest it, and maybe a December low sees above or below a low relative to the October 6th low. That's just conjecture at this point. I don't know. We'll need to see how things develop.
When was the last time we broke something like this bar? Do you have anything in like the '08 price movement? You know, does any of this look like '08 or 2000 to 2002 or not really?
Yes and no. It's a 7-year cycle decline. So in that regard, the cycles are exhibiting a similar declining structure. But as far as laying one pattern over the next, juxtapositioning, I'm not a big fan of that. Those things work for a while and then they don't. I have not seen a pattern overlay that really looks well. And even if I did, I probably wouldn't trust it.
What about the 1973-74 parallel? We've talked about that off and on.
Well, that was also a significant, very significant decline in the market. The market, that was a 7-year cycle top in January of 73. And the market went south for about 2 years. It bottomed in December of 74. And the popular averages shaved off about 50%.
Wow.
It was quite a brutal market, and some stocks went down even more.
Wow. So let's go to the S&P chart here. Let's talk about this.
Yeah, this is the S&P 500 current through the close today.
Get it out of this view. Where are we?
Right there, double click on that one. There we go. The market as measured by the S&P 500 was down at Fibonacci 55 today at the close. As you can see, we have broken the June lows.
A Fibonacci what?
Well, the markets very often move intraday Fibonacci numbers. And I don't want to get too technical, but one of the Fibonacci numbers happens to be 55, and the S&P 500 closed down exactly 55 points today. I see that a lot.
So what does that mean? Went down 55 points.
It doesn't mean anything.
Oh.
It's just, oh, by the way.
It's just...
It may or may not be down a Fibonacci number Monday or Tuesday. Sometimes those things happen, sometimes they don't. I just find it interesting.
So we're down
when it does.
55 on as of Friday.
Yes.
I mean, there's some some support here, right? Going on.
Well, the 3750 was a support level.
I don't know what happened here.
And we've taken that out. And I would say if the Dow were to decline down to 26, 27,000-ish over the next week,
that might be.
That might see the S&P go down a commensurate amount, say somewhere down into the low 3,000s. I can't say with certainty, of course, what the magnitude of any decline would be, but that would be a reasonable expectation.
Sure. I gotcha. So what else does this chart tell us?
Well, all of the three moving averages on this chart, the 15-day in green, above that is the 50-day in blue, and way up at the top in the middle of the page in red is the 200-day moving average. All three of those.
Well, the 200-month.
This is
That's not the 200-day.
This is a daily chart, so these are all daily moving averages. All three of these are pointed straight down for the moment. So when we see some type of bottoming formation, first we would need to see that 15-day in green flatten out, level off, and then turn up. That would take price movement above that line. That has yet to happen.
What about you get people just say, you know, Stan, if you just follow the 200-day moving average and you're in the market when it's above it and out of it when it's below it, you give any credence to that? Seemed to have worked, would have worked in this market.
Yes and no, but even in the uptrend, I believe we had a break below the 200-day. That's something I look at, but I wouldn't advise anyone to trade on that alone.
Okay.
Now, certainly over the last year, the 200-day moving average served as a resistance, both at the March 29th high and the August 16th high. You can see we went up and we kissed it exactly.
Bam.
And repelled.
Yeah, that's breathtaking, how quickly we went down from the summer. Okay, now let's talk about, actually we'll take a short break, folks, and then we'll talk about the 30-year fixed rate mortgages. Where are mortgages headed? Will there be any relief in the mortgage market? And folks, if you want a copy of Stan's latest work, you get that free when you schedule and keep your no obligation 27-point review. If you have questions on technical analysis, call us 800-321-0710 to get on the program, or you can type in the chat box on YouTube or Clubhouse and call us today at 888-988-JOSH and get a free copy of his work when you schedule and keep your no obligation review at 888-988-JOSH. That's 888-988-JOSH. We'll talk about mortgages in a brief moment. And we return talking about the 30-year fixed rate mortgage on Spotify, iHeart, WOR, and YouTube and Clubhouse right now. So 30-year mortgages bottomed in 2021. We talked about our 2020. Remember, I called the exact bottom in mortgages. We should have traded off that. But anyway.
I think you refied your house right about that time.
The exact bottom.
You nailed it.
I remember we talked to our good buddy, and basically we hit the low, and now we're up to 6.7. Is this true? 6.7?
Yes, this is as of today.
I mean, that's ridiculous. That tells me the real estate market's going to crash, but we'll get to that later. So tell me what's going on with this chart.
Interest rates have absolutely skyrocketed here over the last 2 years. I can't recall having seen a rate of ascent at this kind of a slope ever in my professional career. I mean, rates have literally gone straight up. Now, this rate of ascent won't continue forever. Right now, interest rates have gone back into the area of the highs in 2006, 2007, 2008, right in the mid-6 range. I would expect we might see a modicum amount of stalling out in the movement higher here for some period of time. But down the road, I think the path of least resistance is going to be higher. It's northbound. Interest rates are probably going to go substantially higher over time. Near term, though, I think they could stabilize right in this area.
Substantially higher?
I do believe that, yes.
How is that sustainable?
That's what the cycles suggest.
Yeah, you've been on this. I mean, you said 8 to 9. I don't know, a few months ago, a year ago, and I was like,
We're not far from that now.
So you were pretty firm on that. What led you to believe that? I know there's this 40-year cycle. Is it just the 40-year cycle?
Well,
in debt?
Well, and we looked at that in a prior program.
Yeah.
Yes.
Explain the 40-year cycle first.
Yes. Going back hundreds of years, interest rates have demonstrated a propensity to make a major reversal every 40 years. 40 plus or minus about 2. 38 to 42, right in that range. We had a high in October of 1981. Prior to that, we had a low in the summer of 1940, another low in 1900, a high in 1860, and so on. So every 40 years, plus or minus about 1 or 2, interest rates reach a major inflection point. The last one was October of 81. You add 40 years to that, and you get October 2021. Well, look what happened. So absolutely, we've seen a 40-year cyclical turn in interest rates, and they are now heading higher. When these 40-year pivot turns occur, interest rates don't just creep up or creep down for a year or two. They tend to go for years, sometimes decades. This last one went for 40 years before reversing. So I don't know yet when this is going to peak out, but we're looking at a number of years of steadily increasing interest rates.
Any sign it would stop or cool down a bit?
Well, in the near term, we are up in the area of interest rates where they were in 2006, 7, and early 2008, up there in the 6.5 region. I would expect some technical resistance, given that we're in that same area. So I think we will probably stop going higher, chop sideways for a while, for several months, but ultimately continue higher.
Wow. So, man, what does that spell for the real estate market?
Well,
let's go to the next chart.
Let's go to the next chart. Oops.
We'll do some Bitcoin too. Okay.
Here we go. Here's the Case-Shiller Index. This is the data that just came out this week. There's always a 1 month lag in the data, but the Case-Shiller Index appears to be topping out, and we probably peaked out last month. This is the national index. Different regions around the country, some peaked a little sooner, some haven't peaked yet, but the national index is giving indications that it is topping out right about now, and I've been looking for a high in the latter part of 2022 for some time based on the cyclical work I've done.
Now, a while ago, you said the low could be 2025, because I said, when would you buy a house? And you said 2025. Are you still holding to that?
No,
or?
the cycle is about 64 months, roughly 5 1/3 years. So assuming that we just topped out in June, add about 5.5 years, that would give us a pretty good clue where to expect the next low.
5 years from now?
Yes. The last move from September of 2006 into early of 2012, February of 2012, went down 64 months. Exactly. That's a little over 5 years. So I would expect...
So would people wait 5 years? Would you tell people, hey, wait 5 years to buy a house?
No, a lot of people will play catch the falling knife.
Okay.
And they will probably get burned. And they will buy in too early. But the analysis, the cyclical functions that I have under study would suggest we're looking at about 5 to 5.5 years of downside following this peak that appears to have just occurred.
So I got to wait. I should wait a while.
2027, early 2028 for a bottom in real estate prices. Yes.
Wow.
Yes. Very analogous to the last one.
Well, I know one of our good friends who just bought a house, but I told him not to. He said his wife would kill him. Well, so sometimes your personal life trumps things like that, but
well, it depends on whether you're buying a home to live in and you have no plans to sell it and you're going to stay there forever. Then price probably doesn't matter. A simple, very very simple technical indicator from this chart that it works exceptionally well. Look at where the price bars, which are in blue, these are monthly price bars. I pull these off the Fred U.S. government website and then plot them. The red is an 18-month moving average. So take note of where the blue price bars cross either above or below that 18-month moving average, and it's a very, very good buy and sell indicator. So very shortly, I would expect the blue price bars to break below
the red.
The red, that will be the sell signal. And basically, you don't want to buy real estate until the blue crosses back above the red, just like it did back between 2006 and 2012.
Well, Stan, you're wrong because no, I'm kidding. I bought right about here. I bought my primary house right at the perfect time to buy in the bottom, but it was 2010 here. I guess regionally it's different. This is the average, which makes sense. Florida, Nevada, Arizona were hit so hard negatively. Took a while for that to burn off. So the average...
They bottomed in
That makes sense. Yeah,
they bottomed in May of 2009.
Different plans. So yeah, no, I bought at the absolute best time to buy commercially and residentially. The hardest thing with waiting on real estate is always patience, right? Like you wanted to buy a home, I know.
Yes.
And you know, I remember, this is financial tip of the day. Don't be persuaded to buy a nice house because of your in-laws or because of the Joneses. I remember we just started having kids and people were like, you live here? You know, I lived in this row home in like you know, it just, we had 2 bedrooms. It was a fine, you know, working class community, but we were growing and people were like, hey, you know, you need to, you know, get a bigger house. And I was like, yeah, just wait. I'll buy when I buy. Because my theory was, this was back then, wasn't based on all these charts and cycles. It was based on affordability.
Sure.
And I was like, you know what? I thought 400,000 or 500,000 was a lot for a house. And in the early 2000s, those houses were going for like $1 million. I was like, who the heck's supporting these types of houses? So I just thought naturally things are going to come down. Same thing now. Like a starter home is what? 400,000, 350, and a
Depending on-
nice house
depending
is
on where
like
you are,
700,000.
Yes, in this area.
You know, you can't,
Jersey.
who can afford that? And so I could see things cool significantly in the next few years where we are. Suburbs are still hot. The one thing I've had demographers tell us where you might be off, I kind of think you're right on the real estate market. They say, well, demographics are better, meaning there are more buyers now and fewer homes. So I don't know, have you given that much thought, or it doesn't really, the cycles work doesn't?
Well, that's, yes, but the charts take all of those factors into account. And it's a meeting of the minds.
So maybe
of
it
buyers and
factors in
sellers.
on magnitude,
Yes.
but
Yes.
not
And now
direction.
prices have gone to an upper extreme, and somebody is saying, I'm not paying up. I'm going to wait for a downtick. And that cascades, and that's what creates the downward movement in home prices.
Okay, so Clubhouse, if you have a question, type it in the chat box. YouTube, type it in the chat box. Where are we going next, Dan?
We got one final chart here, Josh.
Okay,
on
so we'll
Bitcoin.
go back to thoughts on Bitcoin next, and we'll take questions from the audience. We have a couple more segments left, 2 more segments left. This is Josh Jelinski, the financial quarterback, and if you want Stan's charts for free, schedule a no-obligation review 27-point ultimate financial game plan now, 888-988-JOSH. That's 888-988-5674. And we will chart your top 5 holdings from a perspective of risk, fees, and taxations for free if you call us now, 888-988-JOSH, utilizing Stan's work as well as my own and our team at Wealth Quarterback. So call us, 888-988-JOSH, 888-988-5674. Friends, don't let yourselves do it alone. We can help you. 888-988-JOSH. We'll be back after these messages. And we return with Stan Harley talking. Now we're going to Bitcoin. You have some Bitcoin charting. Go ahead.
This is a chart of Bitcoin right through today, because Bitcoin has moved in very steep fashion. It serves us well to plot it in log format, which means each movement on the chart relative to a base 10 factor is the same width. It just makes it a little bit easier to see what's going on with Bitcoin. And what I've done here is I've marked all of the significant highs in Bitcoin. I believe the high we saw in November of last year was the latest significant market peak. And now we're heading south. The interesting fact of late, certainly for the last couple of years, Bitcoin and the S&P 500 have been somewhat correlated. They've been making their highs and lows together on about the same time frame. That won't last forever, of course. At some point, that anomaly will diverge.
Yeah, it seems like they move almost, in tandem. Bitcoin's a little bit before. Have you noticed that?
It tends to lead. Sometimes you've called me up on the weekend and said, "Hey, Stan, Bitcoin's up. Stock market's going to rally on Monday morning," and
then it rallies.
It rallies. It's a great call.
It will work until it doesn't.
It will work until it doesn't. Yes, it won't last forever.
It will work until the market figures it out, basically.
But right now, Bitcoin is in a declining phase. How far down it goes is difficult to forecast. We're at about 18,000-ish right now. It moves 1,000 points a day. But by the time the decline is over with, it would not surprise me to see us tagging 10,000 once again.
And back to truck up. You're very bullish after.
Well, yes.
Right.
Yes. But the 2 prior peaks poked their head above 10,000. Those were areas of resistance. So in an ensuing decline, very often price pulls back to test those former highs. So since those former highs were up in the area of 10,000, it would be reasonable to expect the decline that we're in right now to find some kind of support in the same area of the December 17th high and the June of 2019 high, which was around the 10,000 and change area. So that's what I'm looking for.
Why
for
do
a
you
pullback.
use a log chart when charting Bitcoin? Because this would be bullish long term, meaning the next kind of threshold to break, maybe this decade, is 100,000. Maybe in a few years.
Maybe down the road. But for now, we're between 10 and 100.
No, but you've observed some base power of 10.
Yes,
Because it's an exponential
yes.
technology.
Well, as you can see from the chart, the significant peaks have generally occurred within the range of some base power of 10. The peak in 2011 occurred above 10. The peak in 2013, just above 100. The peak in the latter part of 2013, just above 1,000, and so on. Interestingly, the current run that peaked out in November of last year never made it to 100,000. What does that mean? I don't know. I'm not sure how to spin that one, but it could mean we have seen a significant high. So this bullish enthusiasm for Bitcoin 100,000 might be a bit overdone, and it might mean that the high we saw in November last year may stand for some time. But in terms of an area to look for support, again, I would emphasize the 10,000-ish area looks very compelling.
Do you have any other charts for us?
That's our final chart.
Well, thanks
today,
for
Josh.
sharing the charts. Folks, if you have a question for Stan, give us a call, 888-988-JOSH. We will review your portfolio for free, 888-988-5674, your top 5 holdings from a standpoint of risk, fees, and taxation. So let's talk about, people don't really know how to manage risk. How would you talk to somebody who needs to manage risk? How would you emphasize risk management?
I think when embarking on any type of investment, one needs to plan out some type of strategy. And the strategy encompasses both price levels as well as some type of function regarding how much of one's money, one's capital does one deploy. So for example, if I was going to invest
Position sizing.
If I were going to invest in the S&P 500, like the IVV or the SPY, for example, and I had committed in my mind $10,000 to put into the S&P 500 ETF, would I go in all at once? Heaven's sakes, no. What I would do is, through either my form of analysis or maybe fundamental analysis, some type of analytical function, determine when I think a good time to buy the S&P 500 would be, and then go in incrementally. So if I had 10,000, maybe I would go in with 2,500 initially, test the waters. And if the investment proved itself, maybe I would add some more. Or, more importantly, let's say the market went even lower from my initial investment. Then I have to decide, is my analysis sound? Maybe I'm just a little early. If so, I'm just going to hold what I have. Maybe I add more. Or maybe I've made a mistake here. Maybe I should get out, stop myself out. It's a complex undertaking. The point being is one should never go all in from the get-go. One should have some type of what I call an algorithm, if you will, to manage the entry into an investment. Now, when it's time to get out, generally it's time to get out. If you're a little unsure, maybe you take 50% off the table. If you're really feeling like, okay, I think this is the top, it's time to get out, you hit the sell button, you get out at the market, and then come back another day.
And you don't worry too much about tax implications. You're more into capital preservation. I mean, we care about that as a firm.
As a firm, we do, yes.
So we have people with legacy positions. They don't want to sell due to cost basis. We do tax loss harvesting, cost basis reconstruction, all that stuff. But I just mean, as a general principle, too many people sometimes think they let taxes wag the dog.
Yes. I think that's not the best way to approach investing or trading, depending on your time horizon. I think it to be more appropriate to look at the opportunity and look at the risk. And if the risk appears adverse, then get out and pay the tax man or take a loss if it's appropriate. Now, let's imagine a scenario where we're coming up within a week or so of a long-term capital gain. As you all know, if we hold an investment for 1 year and 1 day, then a short-term gain becomes taxed at a long-term gain. That might weigh into one's decision-making in terms of whether to get out. But if we're many, many months away and we don't like what we see, let's get out and either lock in a profit or take a loss if it's appropriate.
Oh, fantastic. So you say there are 3 prerequisites to sound money management. I will reveal those 3 things when we return. This is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back with Stan Harley. What are those 3 things that investors need to know about?
Josh, I think there are 3 facets to this world of investing that we're all in that are just critical to making it a success. The first one is what I call asset allocation or asset selection. And that's what most of the investment world focuses on. And that's what most traders and investors focus on, is strictly the asset allocation function. Where am I going to put my money? Am I going to go into the S&P? Am I going to go into biotech? Am I going to go into Apple Computer or Amazon? But there are 2 other important factors that need to be considered in the
And
process.
mind you, I've seen asset allocation done properly, like we do it with our strategic portfolios. And I've seen it done in a lousy fashion, where people put everything in the same ETFs. And although we like ETFs, we properly weight them, we position size them. Just because somebody has index funds or ETFs, it's not a panacea.
Absolutely. So what I'm talking about here pertains to either an ETF or an individual stock or even Bitcoin, for example. Where do you deploy your capital? That's the number 1 consideration. Number 2, and equally important, is the when, the timing aspect. And one doesn't have to do the detailed market timing that we do here at the firm, the serious number crunching, but look at a chart. Get a kind of a sense of, is the market in a downtrend? Is it an uptrend? Is it in a basing function? Try to get some sense in your own mind, is this a good time to buy or is this a good time to sell? That's what I call the market timing aspect. And the third, and perhaps the most critical of all, function that has to be managed is what I call risk management or money management. You decide where you're going to put your money, number 1. You've decided when, but those can be off a little bit. So the third function that has to be managed that can perhaps make up for the other 2 is what I call the risk of the money management. That means what percentage of my chips do I deploy at the outset, and what percentage of my chips do I deploy as the investment evolves, whether I add to or subtract from, and then when do I take it all off the table? It can be very complicated or it can be very simple. I think at the simple level, if you take your money, as I was talking about earlier, and maybe go in a quarter, that makes sense for most of the time. You won't nail the exact bottom, but if your timing is reasonably accurate, your average price might be fairly close to the low. This is not the same thing as what some people refer to as going in with the same amount of money. There's a term for it, and it's escaping me at the moment. But it entails prudent risk / money management, and I think
Dollar cost averaging.
Dollar cost averaging. That was the term I was
It's
thinking.
not the same thing as dollar cost averaging. It's you're sort of legging
Right on
in,
the tip of my tongue. Yes.
seeing if your conviction's right. If it
Yes.
is, you leg in a little more.
Yes.
If it isn't, you keep your chips.
You keep
hold your
powder
chips
dry.
back.
Yes.
Yeah.
So if one masters or even comes close to mastering those 3 functions, then the process of investing or trading can be a successful undertaking.
So, what are your thoughts on real estate? I know you do some real estate charting. You don't have a chart today, but what do you think about gold? I mean, gold and silver.
Metals. Didn't bring any charts today for the metals, Josh. I see the precious metals complex as etching out a sideways basing evolution. Yeah. Yes. Gold on the top end about 2,000. On the lower end, 1,700-ish. Could even go down to 1,500 perhaps at the low end. Some of the cyclical work I've done suggests there's a 94-month cycle in the pattern of gold. The analysis would suggest October of next year, plus or minus a couple of months either side of that date, might be a good point to look for a major low in gold. Now, a low could be a lower price, or it could be the apex of a sideways base, which is kind of what I think is likely.
Yeah, that's what I think too. And then we'll start legging higher.
And then we'll start legging higher from there. Yes.
David Ranson has a lot of good charting work on gold. We'll have to have him on that. So anything else you'd like to share with our listeners that you haven't shared this hour?
Josh, I think we've covered just about everything.
Well, thank you. And folks, if you have a question, type it in the chat box. We'll bring you up. Want to thank you all for listening. And again, if you want us to score, we will do technical charts on your top 5 holdings. Call us now, 888-988-JOSH for free. Top 5 holdings. We will score them from a perspective of risk, fees, and taxation. Nobody's doing that for you. Call us now, 888-988-JOSH, 888-988-JOSH. I want to thank you, Stan, for joining us. It's great to have you aboard. And you have big kahunas. You can deal with the markets on a daily basis, and the stress of the markets, and talk to many listener friends on a weekly basis. So thank you for all you do, folks. Give us a call. Somebody want to know, what do you think about? What do you think about oil? What do you think the oil markets?
Didn't bring any charts on oil today, but
somebody want to know about oil.
Yeah, I think oil probably saw resistance up around the 125 area, and a number of months ago, and I think that might last for some time. If we go into an economic recession, which is what the stock market is telling us may be coming, then the appetite for oil is likely to decline. So betting on much higher oil prices near term, I think, is wishful thinking. I think oil is likely to chop sideways. It's a little bit below the 100 level right now. I think we're likely to see oil chop either side of 100 for a while, well into next year.
Thank you. Thanks, Stan. And folks, you can get his, your website is harleymarketletter.com.
Yes.
So if you want to subscribe to his newsletter, go to harleymarketletter.com or call us at 888-988-JOSH and request your free 27-point ultimate financial game plan. This is Josh Jelinski, the financial quarterback, signing off. Thanks, Stan. Thank you, everybody. We'll be back on.